All right, so chapter 6 is all about accounting for income taxes. And so what does that mean? Well, remember in chapter 5 we talked about book tax differences. Well, now chapter 6 we have to get those onto the balance sheet essentially, because those have a value to us, those differences between book income and tax income, okay? And so what we end up talking a lot about in this chapter is the oops, moved that around and I didn't mean to. Is the income tax provision. Okay. And so the income tax provision contains two pieces. You've got the current piece, and then you've got this future piece. Okay. And this future piece is typically what gives folks the most trouble. And so when we're dealing with this future piece, okay, we have to record future income taxes payable or future income taxes refundable. And so that's where we get this concept of the deferred tax asset or deferred tax liability. So a deferred tax liability are future taxes payable, and a deferred tax asset are future taxes refundable. Okay? It is important to remember that when we're talking about ASC 740, we're only talking about income taxes, but we are talking about federal taxes, state taxes, and any international income taxes that a corporation might be subject to. Okay, so your non-income taxes are expenses, of course, and they go into the computation of net income before taxes, and so they're above the line expenses. All right. Also, when we talk about ASC 740, we have essentially two approaches. Okay, two objectives, I guess I should say. And that's to recognize the income taxes payable or refundable in the current year, and then to deal with the future impacts as well. Okay, it's important to remember that these both objectives deal with a balance sheet approach. Okay, they're not really dealing with the income statement. They're dealing with assets versus liabilities. All right. Obviously, we've talked about book tax differences a lot, and we're talking about when we talk about these book tax differences, we're talking about timing differences. Now, some of these timing differences are permanent in nature, right? Because not all book income is taxable, and not all book deductions are also tax deductions, all right? All right, so this slide talks about the steps in determining the income tax provision, all right? And so we're going to kind of move things up a little bit, and we'll go from here. All right, so notice in these steps that it kind of takes place in two general pieces, the current piece and then the future piece. Okay, so remember that you have two parts, the current and the deferred. And then also remember that if you have temporary differences that are cumulatively favorable, what does that do? Well, that causes your taxable income to be less than your pre-tax book income, and that's going to eventually create deferred tax liabilities. All right, now, alternately, if you have temporary differences, that are cumulatively unfavorable, so your taxable income has been higher than your book income. So think about it. If your taxable income has been higher than your book income, you've paid a lot of taxes relative to what you would pay on if it was calculated on your book income up front, right? So what does this do? This is going to create deferred tax assets. Okay? So try to keep those straight in your head. Okay? All right, here is the formula for the provision process. We're not going to spend a lot of time on this slide because we'll have plenty of time to put this formula into action with some practice problems. All right, remember when we're talking about permanent differences, permanent differences are not going to impact our deferred tax assets and liabilities, but they are going to impact the reconciliation and its effective tax rate. All right, and the problem that we're going to do will we'll do an example of this reconciliation. All right, so this is a great slide because it kind of gives us the nuts and bolts of all of the different varieties of temporary differences and the tax carry forward amounts, okay? And you've got essentially four different flavors of these, all right? And remember, temporary differences are things that are going to reverse over time. All right, so I'm going to resize this because I'm going to add just a little bit of detail to each one of these four categories, okay? So first off, if we deal with these revenues or gains that are taxable after they're recognized for financial income, what do we end up with? Well, we end up with, this is favorable, right? And an example of this could be installment sales, okay? What about expenses or losses that are deductible after they're recognized for financial income, okay? Well, if they're deductible for financial but not deductible for tax, they're unfavorable, okay? And what's a great example of these? Well, what about bad debt expense? Really anything using the reserve method. So I'm going to make this a little bit bigger here. So warranties would work as well, right? Because lots of times there's a warranty reserve. Okay, what about revenues or gains that are taxable before? Okay, well, this is unfavorable, right? Because you're paying taxes up front. And so any kind of prepaid income. Okay, and then expenses or losses that are deductible before they are recognized for financial income. Okay, tax depreciation. Okay. And we should be precise and say excess tax depreciation, right? Okay, so that gives you some examples to go with each of these kind of 4 flavors of temporary differences. Okay, so this slide again is talking about tax expense and benefit and identifying taxable and deductible temporary differences. We're not going to spend a lot of time on the discussion of this. All right, so again, remember we're talking about a balance sheet perspective. And then if there is a future tax cost, that is going to give rise to a deferred tax liability. All right, alternately, if there's a future tax benefit, that is going to be a deferred tax asset. All right, so this slide again touches on some of the theory behind ASC 740, but let's remember that the major component of a company's current income tax expense or benefit is income tax liability or a refund from its current year operations. Also remember that when we're talking about the ending balance, all right, what we have to pay attention to is the change in a company's deferred tax liabilities or assets, okay? And again, we're talking about a balance sheet approach, okay? And we're talking about the change in differences. So you need to keep track of what happened last year, because that's going to give you your last year's ending balance, right? Is going to give you your current year's beginning balance. And then you have to keep track of the changes of all of these things. All right, so here we have a really short example of the current portion of a tax provision. And so what are we given? Well, we're told that its pre-tax book income is $1,000. And then we've got 4 book tax differences, okay? We've got tax exempt interest. It's recognized for books but not tax. We've got accrued warranty, recognized for books but not tax. A non-deductible fine, recognized for book but not tax. And then depreciation in excess of book depreciation, okay? And then over here, we've got P's and T's related to whether they're permanent or temporary. Okay, now the next slide has the solution, so you can look through this on your own, but I also wanted to discuss it because this is how we're going to be computing the current portion of the tax provision, all right? So we start out with our book income, and then remember tax exempt income comes out of book income as we get to taxable. So this is favorable. Accrued warranty has to get added back in. It was deductible for books, not for tax. A non-deductible fine was deductible for books, not for tax. So those are both unfavorable. Tax depreciation in excess of book depreciation, okay, that is favorable. And so we end up with taxable income of $1,200. Multiply that by our set corporate rate, and you get the current tax provision. All right, now, so we've gone into how to calculate these deferred tax assets, but what we also have to do is kind of opine on whether we're actually going to get to recognize this deferred tax asset, because remember, sometimes these are long-term deferred tax assets, okay? So if there's a more likely than not chance that some or all of this deferred tax asset is not going to be available to us in the future, then we have to create a valuation allowance that would be a contra account to this deferred tax asset, okay? And there are four sources of potential future income that will impact the calculation of this. So let's talk about those next. All right, so here are two objective sources. So reversals of existing taxable temporary differences, and then taxable income in prior carryback years, okay? So these two objective sources lay out situations by which you do not have to record a valuation allowance, okay? Now, there are also subjective sources, and they also give you kind of a way out of having to have a valuation allowance. Now, the fact that these are subjective tells us that that these are somewhat based on your perspective. So a company might support its predictions of future taxable income with evidence of existing contracts. So these are, the difference between objective and subjective. Objective meaning everyone can see the rationale for it. Subjective meaning it's based on perspective. So this is these subjective sources. This would be the company gathering evidence to make its position believable, if you will. All right, this is kind of a long laundry list, if you will, of different tax planning strategies that companies can use to try to eliminate the need for a valuation allowance or at least lessen that valuation allowance. Okay. I'm not going to spend a lot of time discussing these. We're going to do some valuation allowance examples, and those should help with that discussion. All right, so a company is not allowed to only consider positive evidence. They also have to look at negative evidence. So if there are factors that would tell them that it is that they need a larger valuation allowance, then they also need to recognize and present that evidence. All right, and then here's a whole list of negative evidence, all right? Losses, and you'll notice that losses in recent years, right? Capital losses, expectations of losses, okay? Unsettled circumstances, so any kind of legal situation, okay? Or a contract negotiation that doesn't look like it's necessarily going to go favorably, all right? Those could all impact whether a valuation allowance is needed. Because if you don't have taxable income, then the value of your deferred tax asset is significantly less. All right, so this slide kind of gives us a little bit of history. We used to deal with FAS 109, and that was, discussing book to tax differences and how to deal with uncertain tax positions. And then it had to be augmented with FIN 48 in order to get us to this point where we had a valuation allowance requirement. So this is just talking about the kind of the reach of ASC 740, and it deals with all of these different, so anything previously filed, anything expected to be filed. So it's a pretty broad-reaching regulation. All right, so there have been a lot of slides kind of on the theory of this valuation allowance. Now we get down to the evaluation of tax positions. And so first you have to recognize, all right? So what do? We have to determine whether it's more likely than not that its tax position on a particular account will be sustained. And then we determine the amount that it expects to be able to recognize, okay? So that's step one. Then we have to measure that, all right? So we have to recognize the positions, and then we have to measure them, Okay? So, and we can recognize an amount if it has a greater than 50% probability of being sustained. All right? So this is the bar that you need to remember. Okay? And the amount not recognized is recorded as a liability on the balance sheet. So what you think that you're not going to be able to recognize has to be recorded as a liability on your balance sheet. All right, when it comes to the recognition of interest and penalties, you actually have an option. They can be included in the provision, or they can be reported as a deduction when you compute your pre-tax income. So if you have interest and penalties, you have an option of how the corporation would report them. Okay, after you have calculated all of your uncertain tax positions, what do you have to disclose? Well, this gives you 3 categories of things. Okay, so increases or decreases as a result of tax positions taken during a prior period. Okay, amounts of decreases in liabilities related to settlements with taxing authorities. All right, so maybe you had an audit hanging out there, and now it's been concluded, and you know what the IRS's decision was, so you have to disclose that. And then reductions in liabilities as a result of a lapse of statute of limitations. So if you have 3 years to worry about an audit, and now those 3 years have passed, you can release that amount as a liability because you no longer have the risk of audit, obviously assuming that nothing extraordinary has happened. This slide just gives you a kind of a visual way to organize your calculation from the beginning of the year to the end of the year. All right, so it gives you kind of a way to organize your thoughts as you're working through problems. This is important to note. So as far as the classification of the balance sheet goes, we've already talked about the fact that you have to disclose deferred tax assets and liabilities and classify them as non-current. Okay, but also it's important to know that you cannot net deferred tax assets and liabilities from different tax jurisdictions. You have to list them all out separately. So if you operate in 23 states, you can't combine them all into one account. You have to have deferred tax assets and liabilities related to each of those 23 states. Okay, that's very important to remember. All right, this is more dealing with what your disclosure has to include and how it must look. Okay. Remember that some of the provisions of ASC 740 relate only to publicly traded companies. Okay. So these are relating to publicly traded companies. All right. Some of the things we talked about a couple of slides ago relate to public and private. These are public only. ASC 740 also requires you to, or requires a company to reconcile your tax provision with the hypothetical tax provision. All right, and we're going to do an example of that. And then one of the things that we also have to calculate is their GAAP effective tax rate. Okay, and I just wanted to talk for just a minute about why effective tax rate is so important. And it's so important because it really is a way to compare a company to its peer group. All right, and why is effective tax rate better than marginal tax rate in that regard? Well, right now, all corporations have that 21% rate, and so you would think that that would be a great way, or it would take all of the comparison out of it, except it doesn't, because as we know, tax planning can lower your effective tax rate. And so it's very important to be able to compare companies based on their effective tax rates. Okay. Also, from an analyst perspective, analysts like to look at cash taxes paid. Okay. So if you take cash taxes paid divided by their pre-tax book income, that is what analysts like to look at, because that takes the deferred tax piece out of it. Okay, so that's it from a lecture perspective for Chapter 6. Stay tuned for a practice problem to be uploaded in multiple parts, because it'll be a comprehensive problem. Thanks a lot, guys.